Now we move into Learning Objective 6.5 and explain the concept of operating leverage. Operating leverage measures how sensitive profit is to changes in sales volume. If a company has high fixed costs and low variable costs, profit changes rapidly with sales. This creates higher profit potential, but also higher risk. The key measure is the degree of operating leverage, or DOL. The degree of operating leverage is equal to the contribution margin divided by operating income. A higher degree of operating leverage means profit is more sensitive to sales changes. Here is an example. If contribution margin is $31,239,950 and operating income is $6,239,950, then degree of operating leverage is approximately a 5. This means for every 1% change in sales, the operating income will change by about 5%. That is a powerful concept because it shows how cost structure creates risk and reward. Now let's look at an example, continuing the automotive example we looked at earlier in the chapter. You can see that a change of 10% in sales results in a change of 50% in operating income by looking at the percent change column. That shows that a dollar increase in sales results in about a $5 increase in operating income, or 1% increases operating income by 5%. You can increase operating leverage by replacing variable costs with fixed costs. For example, you might replace manual labor with robotics. The benefit is that fixed costs allow more profit at higher sales because costs remain flat. Higher leverage equals larger gains or losses based on sales. Stable industries prefer high operating leverage because they have predictable sales. Unstable industries should be careful because more leverage equals more risk. Let's take a look at the cost structure in our earlier example, where the fixed costs equal $25 million and the variable cost per car was $9,955. You can see the break-even point is approximately $49 million, or 2,489 cars sold. The profit is represented by the space between the total sales and total cost line, whereas the loss is represented by the space below the break-even point. Now let's take a look at what would happen if we increased our operating leverage by making an investment in robotics. Let's assume that the robotics investment increased or actually doubled our fixed costs to approximately $50 million. You can see on the graph that the fixed cost line has risen to the $50 million point. But because we've invested in robotics, our variable costs, or our labor, has actually reduced, and now our variable costs are $4,978. We have a new break-even point of $66 million, or 3,328 cars. That break-even point has increased because our fixed costs are now higher. However, you might notice that the gap between the total sales line and the total cost line has widened. That widening of the gap demonstrates that our potential for even larger profits has increased with the investment in operating leverage. However, the gap has also increased below the break-even line, meaning our potential for loss has increased as well. Higher fixed costs increase leverage. They amplify profit, but also loss potential. Let's reiterate the practical business applications of operating leverage. The benefits is a potential for higher returns. The risk is larger losses in volatile sales environments. You need a balanced strategy. Managers balance leverage to maximize profit while managing risk. Now complete learning activity 610. The Dan Marshall Band earns $1,500 per event. They rent equipment for $500 per gig. They're considering buying equipment for $25,000 usable for 5 years. You will compare profit under renting versus buying. Then compute degree of operating leverage under both scenarios. Finally, use degree of operating leverage to project profit changes from a 10% sales increase. Pause here and complete the activity. Check your answers on the back of Chapter 6.